Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
I believe that because most commodities have been cut in half in price. I mean, soybeans were at 16. We went down just a little under 850. Gold was over 1,000. We haven't seen a 50% retracement off of that move this year. Stocks certainly have been cut in half from their peak in '07, and some individual stocks are almost completely decimated. There's just, if you look across the spectrum of things, I'd say looking at where crude oil went, it did reach more than a 50% correction from its peak to trough from this summer's high of around 147 and change, where we saw the November contract trade under the $61 mark. So we've actually seen some markets move in half, but if you look at all the commodities in general and compare them to where we were at the end of 2006, it's interesting to note, very important, at the end of 2006, crude oil, at the end of 2006, I said the beginning of 2007, we are higher in gold. We are higher in most commodities, in the grains, in the meats, especially if you look at where the energies have traded. If you think about it, in the beginning of 2007, people were panicking when they saw crude oil over 50, hitting 60, close to 70. And now we celebrate a move when the market dropped back to 70 and 60 range. The euro currency is actually just about right where it started at the beginning of 2007. So the U.S. dollar, as bad as it got, people are talking about this magnificent dollar rally. The dollar is not really rallying, it's just recovering some of its losses. And I think that you have to go back when you do technical analysis or where you're going to make a trade decision. You need to more importantly find out where's the market been, and then I can make a decision on what the market might do. And then you need to develop a trading plan which incorporates what your risk parameters are and what your profit objectives or your profit exit strategy is. And that's one thing I think a lot of traders miss in their trading plan. If you get into trades at the spur of your pants and say, well, I'll figure all that stuff out later, you're not trading a consistent game plan. I think what we're going to show you today is going to help you develop a game plan year after year in the market arena. Now, as a disclaimer, as you may well know, trading is risky, and what we're showing you here today is for educational purposes. These are examples for, again, educational purposes. Using stops is not going to guarantee any type of loss, and of course, if you're going to trade in the markets, consult a professional on your parameters for risk. This information is proprietary information, meaning this is my original work. I have not copied this work, and therefore I appreciate if people don't copy it, and I don't like to find my work on other competitors' websites. I authorize the ISE to use this information for educational information, as they are one of the leading exchanges for options and specifically even currency options. Now, as we're talking about Forex and trading equities and like markets, especially in the Forex arena, the ISE, the International Securities Exchange, obviously trades through most of your option brokers, specifically securities. Various brokerage firms will route your order. You can also select your currencies, and I'm going to explain to you why there's a big difference and advantage of doing that. With the ISE, they trade some of the top currencies: the Australian dollar, the British pound, Canadian, Euro, Swiss, and Japanese yen. But I want you to notice something. Look at the convection symbol, USD versus AUD, USD versus GBP, the Great British Pound. Look at the Canadian dollar, it's in dollar Canadian. Euro is dollar versus euro. And the Swiss is the dollar versus Swiss, and the yen is dollar versus yen. Most of you have seen or will hear the opposite of that, which would be, for example, in the Japanese yen, you're going to see the yen versus dollar, or you're going to see the euro versus dollar quotation. And all it is it's the same way. It's just an inverse relationship, and I'll show you that as well today. But they do trade not only all these indexes, but these are optionable indexes, more importantly, which helps you define not only risk, but also potential profit objectives. And more importantly, because you have optionable listed securities here, you can develop a slew of different strategies. Buy right, calendars, diagonals, verticals, and the list goes on and on. In deciding what to do, obviously you need an opinion on the market. As an options trader, if you think the market's going nowhere, that is an opinion. If you're bullish and the market's going up, then you have an opinion, and you need to take some type of a trading strategy that mirrors or will take advantage of your market opinion. But most traders don't know how to stay with trending market conditions. When do you get out of the trade? How do you set a profit objective? Most people, and even myself, have a problem with either if I'm in a winning trade, I generally get out a little too early. I scale out of trades personally, and when I'm trading multiple contracts, I'll get out, and then I'll let some ride. Another strategy, especially if I'm in a strong trending market condition and I just don't believe the market can go any further, if I was bullish, for example, is I'll get out of my position and I'll roll into further out of the money options with giving me a little bit more time just in case there's more to the trend. That is a powerful position to take, especially now since we are seeing very hyperbolic trending or trading market environment and market conditions. Also, traders have a hard time identifying when a trend's going to exhaust itself, and that comes from greed. I mean, obviously, you think it's going to keep going, and you don't understand when that trend will cease to exist. And I'll cover some areas that can help you identifying trend exhaustion points of interest. Setting profit and loss points of interest, it's critical. It's paramount, and a lot of traders have a hard time understanding how to get out and when to get out. And most importantly, understanding seasonalities of markets, because they do exist and they are very prevalent in today's market environment and in today's markets, especially the foreign currencies, and I'm going to show you that right now. Since most markets demonstrate seasonal price patterns, meaning they tend to make highs or lows near, that key word there, near the same time period year after year. Now, what's interesting is it's not the exact hour, the exact date, but, for example, if I tell you that between the 3rd and 4th week of October, the euro currency generally tends to bottom out in its last 10-year history, that would obviously be important information that you would have needed, say, in August, right? Well, stocks, commodities, and foreign currencies, as we're talking about today, they do have a strong tendency to demonstrate seasonal patterns, but these moves can be either muted or magnified depending on, A, economic turmoil, which we certainly have. We can even expand that point of interest and say global economic turmoil, as we've seen and are under current conditions. Political events, such as a presidential election, as we're going through today, and fiscal policy changes as governments try to dictate conditions in the market, either by setting higher tax rates, lower tax rates, or passing bills such as tax relief and bailout packages, as the U.S. government and other foreign nations are doing currently.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.